Well, in the never a dull moment department, Tesla couldn't really ask for any better news today. Everything is very positive, but we're still down as it follows the market around, basically a little better than the beta. So outperforming a bit this morning, but fears around interest rates seem to be dominating everything with the CPI and the PPI reports out this week. Tesla is off the lows of the day. It was down as low as 380, which I believe is kind of the bottom, bounced off of that. And the Dow is actually positive at this point. The other indices are kind of headed toward the green. It'll be interesting to see how the day plays out. This is from investing.com. It says, just in, Tesla beats German auto giant Audi in global car sales for the first time in 2024. So here we go as we inch up each year, knocking out a few other of these auto giants in terms of total unit production. Now, as many will tell you, total unit production only matters now because it just makes more potential robocabs or robotaxis. Anyway, this is from Giga Factory Berlin. Like I said, all the news is good this morning, according to this. The actual, the actual account on X for Brandenburg. Production for the new Model Y in Giga Berlin is to start quickly. Tesla plans to start production of the new Model Y in Grünheim as early as Tuesday. The management informed its employees about this on Monday. So there you go. Now we've got the two locations going, making a product. How about Austin and Fremont? What's going to happen there? Let's have some announcements, folks. We want to have them in America as well. All right. This is from Yahoo Finance this morning, citing advances in autonomous vehicle technology and embedded artificial intelligence as the main drivers. Morgan Stanley has raised its price target for Tesla to $430 from $400. It also represents an optimistic target for Tesla's bullish scenario, assigning an $800 price per share. Okay, see, 430. My number's 410 for the short term. Brian is at 450, 430. Yeah, sounds about right. And then the 800 price per share, I'm at 700 plus. I think Morgan Stanley's finally catching up here. Analysts pointed out that Tesla's leadership in autonomous mobility, based on its expertise in a variety of areas, including data collection, energy storage, robotics, and artificial intelligence. In this updated sum of the parts model, Tesla Mobilitas autonomy rideshare business. What? Tesla Mobilitas. What does that even mean? Anyway, they valued that at $90 a share. With 29% EBITDA margin, the business is expected to run a 7.5 million vehicle fleet by 2040, producing $1.46 per mile in income. Wow, that's an interesting. I should bookmark that or something. I should add that to the list because that is not anything close to what I'm expecting. I think by 2040, the production will be around 50 cents gross in income per mile. 7.5 million vehicle fleet might be okay. I'm not sure. And will that just be Tesla's fleet, or is he counting everything? Anyway, interesting. Another important growth engine is Tesla's network services, which comprises software, supercharging, and full self-driving subscriptions. They value that at $168 a share. Morgan Stanley projects this division will account for almost 60% of Tesla's EBITDA by 2040. Under Adam Jonas, the analysts claim the value does not currently represent Tesla's potential in aviation or maritime embodied artificial intelligence areas. They envisions Tesla's first fleet of city-based autonomous cars starting by 2026, and broad acceptance after 2030. Wow. The bear case for the company stays at 200. Adam Jonas, where is the Optimus in here? I don't see anything about Optimus. Well, maybe his is an 800 plus like mine. Barron says this: SoftBank-based Craft Technologies is one company that is betting that AI can deliver in investment and portfolio management. The South Korean fintech has around 60 million in assets over 3 exchange-traded funds. all powered by AI using different investment strategies. I'm only going to talk about one of the three. AMOM uses a momentum factor strategy. That means it targets stocks that have outperformed in the past on the assumption they will continue to rise. Its biggest holdings are, unsurprisingly, NVIDIA, Tesla, Broadcom, and Meta, all of which had impressive runs in 2024. AMOM gained 36% in 2024, while its benchmark, the iShares Edge MSCI USA Momentum ETF, only gained 32%. So not too bad for those two efforts using AI to make market decisions. I certainly think that's going to be a thing, a very big thing. Okay, this is Randy Kirk. This is the time where you like, even though it takes effort. Yeah, come on now. Yeah, okay. Like, subscribe, hit notify for Larry Goldberg later today around 5 and Brian White at 7:45. Yes, and then do all the other things. You know what to do. We had another Patreon. I forgot to get his name. I'll get that name later, and we'll talk about that tomorrow morning. But another Patreon joined up, so thank you very much. A lot of you can do the same thing and help me with the production value. It all helps. All right. The VIX is at 20 this morning. Yeah, it was at 17 and change just on Friday. Now it's at 20. I think it's fair to say that there's uncertainty related to Trump coming to power. And this uncertainty is being exacerbated by worries about inflation and a too hot economy. If Trump does what he says he's going to do, there are inflation potentials, but there's also deflation potentials. So that's what people are not paying attention to. There's a very good likelihood that the economy could get hot. There's also a very good likelihood that the cuts by the Doge Commission could result in maybe a slowdown for a bit. We could have a quarter or two of recession later this year if they start cutting that many government jobs. Because the government jobs, every government job they cut is potential for something in the private sector to be cut also, because there's all this interrelationship between what goes on in the public domain and then the private domain. My big question continues to be, when will manufacturing come back? Durable goods are still in a recession, and I'm wondering if this is some kind of a trend that we need to pay attention to. I don't believe it's just because manufacturing is going more and more offshore. I think it's because people are not buying as much stuff. They're not as interested in stuff. They're more interested in services and experience and eating out, etc. Sir Basher says this. He says, he's got his own philosophy. He says, we didn't exit the industrial age because we stopped using machinery, factories, and mass production. We won't exit the information age because we stopped using computers, telecommunications, and the internet. We still use all those things. Instead, we evolve where new tools and paradigms emerge that redefine how we live and work. We are now entering the autonomy age, where artificial intelligence and automation take center stage. AI software agents will handle complex tasks autonomously. Self-driving vehicles will transform transportation. Humanoid robots will outperform human workers in capability and efficiency. The defining characteristic of the autonomy age isn't the replacement of old tools. It's the advancement of humanity by machines that think, learn, and act for us. This shift will change everything. Good work, sir. I like it. The autonomy age, maybe you'll get credit for having coined the term. Forbes rightly says that if the CPI comes in hot, CPI, did I say that right? If the CPI comes in hot, the PPI comes in hot, the markets will be unhappy. I'm going to restate my position that the bonds are ruling the day. No kidding, Randy. But the interest rates aren't that high. And whether we have a 0.25% cut or a 0.5% cut by the Fed later this year isn't a big deal. Now, the equity markets disagree with Randy. Equity markets and bond prices fell hard after the December jobs report as the dollar and the bond yields surged. However, the markets, this is now them talking, not me. However, the market moves on January 10 were about more than just the jobs report. The strong December 2024 jobs report topped last week's economic docket. However, other data were also positive and stronger than expected. The December ISM non-manufacturing index, meaning the services index, accelerated to 54 from 52. The weekly initial jobless claims fell to a very low 201,000, while the latest JOLTS report increased from 7.7 million to 8.1 million job openings in November. The only truly weak economic data last week was a decline in November factory orders. The week was otherwise filled with upside surprises for the economy. Now remember, NFIB report tomorrow morning. Nobody pays any attention to it but me, but it's important. As a result of last week's solid growth data, the latest Atlantic Fed GDP estimate now shows GDP likely to be 2.7% based on available data through January 9th. Beyond positive growth data, the Federal Reserve released the minutes from the December 2024 meeting of the Federal Open Market Committee, which revealed their concerns about continuing elevated inflation. The chances of cuts by the Fed, this is not the report, this is me, the chances of cuts by the Fed fell to 25% for the next two meetings in January and March. The number is now 55% chance for the meeting in May. So this is definitely, driving in that direction. December economic growth reports that will be released this week are likely to be generally positive, including retail sales, industrial production, and the jobless claims seem poised to rise modestly but remain relatively low. The biggest downside seems to be housing starts and building permits are likely to remain relatively weak and may exhibit mixed dynamics. Yeah, so basically manufacturing and housing, which then the manufacturing impacts trucking. So those three categories and small business, that major category, I think it's 60% of the economy. Those are the categories that are still in recession. Let's call it what it is. They're in recession. The December Consumer Price Index and Producer Price Inflation reports are likely to show modest month-on-month pressures with a risk of accelerating year-on-year CPI and core CPI rates. Despite already elevated inflation rates, Prestige Economics has cautioned that the December CPI report on January 15th could show acceleration. On the upside, they say any acceleration in December year-on-year total would likely be transitory with lower year-on-year inflation rates in quarter two due to base effects. I agree. Housing definitely starting to, I think housing will begin to have an impact, maybe even this week, which would be a big surprise. But remember, I've said that a few times now, housing might actually get us a break on this CPI this week. And then next month, I think we'll definitely start to see housing have that impact. In year-on-year consumer inflation rates, if according to the article, year-on-year consumer inflation rates fall in the second quarter due to this base effects, market participants may be underestimating the potential for 2 or more rate cuts in 2025. Okay, I could care less about the rate cuts. What I care about is inflation being under control. AJ says this morning, listen, I'm just thinking out loud. Market is selling off on very low 2025 rate cut expectations. At most 1 25 basis cut now. 2, this drove yields up near 4.8%. 3, Trump's potential corporate tax cut could offset the effects of 1. Right? So if he cuts corporate taxes, that could help out with the rates. Doge's massive expected cuts to spending could potentially reverse the drivers, which gave us both 1 and 2. And then we could have much lower interest rates, much lower expenses at the federal government level, and a much better ongoing economy, which is the promise of Trump 2.0. Market Watch has this. According to Keith Lerner, chief market strategist at Truist Advisory Service, such pullbacks that we're having right now are just the admission price to the market. They're uncomfortable, but they're not that big a deal. Lerner believes the latest sell-off represents no more than a reset of prices and sentiment, which I've been asking for, begging for months, both of which may have become stretched on a short-term basis, but still leave stocks within the boundaries of an ongoing bull market. Listen, if we only go down 5% on the S&P and between 5 and 10% on the NASDAQ, that's not even correction. That's just like like he says, got a business as usual. We need a 10% correction in this S&P in order to have a correction, and that would probably mean a 20% correction in the NASDAQ. The record levels of investor optimism seen late last year, including a very high percentage of traders expecting stocks to reach new peaks in coming months, left the market vulnerable. When expectations are high, a little bad news can go a long way, he says. The latest piece of bad news, as noted above, is swiftly rising bond yields. Lerner notes that over the past few years, when the 10-year Treasury yield has moved above 4% at an accelerating pace, it has proved a challenge to equities. It's not a coincidence that the S&P 500's recent peak on December 6th coincided with the trough of the 10-year Treasury yield, he said. I think we can have a pullback of 5% S&P and 10% NASDAQ, says Randy Kirk. Now, what do the markets say, however, as opposed to what Randy has to say? Let's look and see. We've got Tesla now pulling back a little bit. It was as low as 380. I've seen it as high as about 388, 389. Right now it's at 386, down 2.2%. We've got the Dow still up after starting off down, but just barely. It's up 0.27%. NASDAQ is down 1.52%, with Tesla down 2.15. So you can see not quite the doubling of the NASDAQ, which we normally see. And the S&P is down 0.77%. All of those have started off lower, gone higher, and now are heading lower again. The Magnificent Seven are all getting beaten down. Apple down 2.76, Google down 1.22, Meta down 2.4, and NVIDIA down 3.66 on continued nonsense. Quite frankly, some nonsensical reporting. You know, they're getting hit the way Tesla gets hit. Tesla's not the only one that gets these ridiculous news stories. All right, all of the Cathie Woods are down as well. RK down 3%, TDOC down 4.66, Square down 1.97. Yeah, so all of them getting hit. Now, normally you'd say, oh, bonds must be, being crushed today. Yields must be up. But the truth is that they're flat. Well, no, that's not true anymore. Wow. 2 seconds ago, they were flat. The 10-year is now up 1.8%, trying for 4.8. We're at 4.792 on the 10-year. The 2-year is unchanged. It's still flat. I don't know what happened to the 10-year, like in whatever it's been, 15, 20 minutes. The 10-year has gone up 1.8 basis points. The 1 month is also unchanged. So the 2-year, the 1 month completely unchanged, 10-year up strongly, approaching 4.8. Okay, let's go see what's happening with oil. Oil continues up, I think. Yeah, another $1.23. We're at 77.80. Crazy business. Brent is over 80 at $80.65. Natural gas, not up that much. Well, it's over $4 though. Up 0.40 at $4 and change. Just call it $4. So the oil market continues to be, of course, we've been mentioning that we have this issue with the Russia supplies, pressure being put on Russia, expecting that pressure to continue with the Trump administration. But I've got to tell you something, production is going to outweigh this. And this it's not investment advice, but oil is not going to stay. Texas Intermediate is not going to stay at $78. I'm sorry. I'll probably be completely wrong, but that's what I believe. Gold down this morning, 24.80, back under 2,700 again at 26.90. Silver staying above $30, but down 2.7% at $30.47. Copper is up 0.64, well above $4 at $4.33. The dollar rising, and as Fed cuts are no longer on the board, really. Bitcoin down 2,391. It has fallen out of the 94 to 104 range. Now back down into that 87 to 94 range at 92,278. We have got that's it. That's all. I've run out of reporting. All right. So as mentioned earlier, Larry Goldberg later today at around 5 o'clock. I think so. He's on the road coming back to South Carolina. So I'm expecting he'll be on at some point. around 5 o'clock. We got Brian White, who will definitely be on at 7:45. That's what you could expect later today. Last night, I did do a couple of reports. I'll put both of them up. One is the regular Monday morning, what I call Monday morning, where I evaluate what's happening all the rest of the week, including the CPI, the PPI, the housing stats that are coming out, the Federation, the National Federation of Independent Business report. All of that, I spell out what's coming and talk about some other things. And then I also did a report last night on Optimus and the thing that nobody's talking about, the $1 billion in go take a look at it. There they are, both cards right there. The one on Optimus is only like 12 minutes long. You definitely want to check that out. All right, so like, subscribe, notify, and join Patreon. Buy a couple of Cybertruck bottle openers. I'm shipping out another one this morning. That's right. People are still buying them. It's been great talking to you.